And hello traders, and welcome to another video. So in this video we are going to talk about liquidity. Okay, so I'm going to explain to you guys what is liquidity. I'm going to show you some charts examples. We're going to talk about it, so yeah, you can understand everything about liquidity. So guys, basically liquidity is everything. Okay, so if there is no liquidity in forex markets, it would be really hard to trade. We have luck, a lot of luck that in forex market there is tons of liquidity. Okay, so there is a lot of liquidity. I don't know exactly how much we have daily turnover, like millions and billions are poured in the market, in forex markets, every single day, and this is why we have tons of liquidity. So for example, if you want to buy an asset, there always needs to be on the other side another seller who is going to be willing to sell at the same price that you want to buy. Okay, and vice versa. If you want to sell an asset, there always needs to be someone that is willing to buy at the exact same price that you're selling. Okay, so basically for every seller there needs to be a buyer. Okay, so this is why, let's say for example, it's hard to sell NFTs. Okay, so NFTs do not have any liquidity at all. Maybe only the popular project like those apes, and CryptoPunks, etc., etc. But the smaller projects usually do not have liquidity. And you're gonna mint an NFT, and you're gonna buy it, and it's just gonna stay there forever. Even if it loses value, you cannot sell it because no one wants to buy it. And this is why it's hard, because NFT space doesn't have a lot of liquidity. Okay, we do not have that problem in forex markets, because there's tons of liquidity, and yeah, you can just buy and sell whatever you want. But right now, when you are buying and selling, you are trading with a smaller amounts of capital. Okay, and that is not the fact for a bank. When bank or some other financial institution, hedge funds, etc., when they want to execute a trade, they are executing that trade with millions and billions of dollars. And again, when they want to do that, when they want to open a trade, they're gonna need liquidity to do so. Because if they want to buy, there needs to be another seller who is willing to sell at the same price level. Okay, and this is where that I always say, like, conspiracy theory comes in place. So there is a little conspiracy theory that retail education as we know it is being manipulated. So the theory is that because banks need liquidity, they basically told us that we should trade the retail ways. Like everybody who started trading for us came across first thing double top, trend lines, support, resistance, etc., etc. So those retail patterns, retail education. And there's a conspiracy theory that banks did that on purpose, give us wrong education, because they can really generate liquidity that way. So we can lose money so they can make money. So for example, you are going to have like a double top pattern. Let's say you're gonna have a double top pattern. Okay, so there is a liquidity right here, a lot of liquidity. Why? Because there is a lot of sellers who are selling at this double top. So right now there is a theory that banks and bigger institutions know about this. So they know that there is a lot of stop losses above this double top. Okay, and if they want to execute a trade, remember they are executing for millions and billions of dollars, and they're gonna need liquidity. So they need to generate that liquidity. So usually what is going to happen is that, you know, price is gonna stop them out, and then institution is gonna come, because, you know, there is a lot of stop losses. You know, institution is gonna liquidate all those stop losses, and they're gonna open a position, you know, then. And, you know, usually this is called stop hunt. You know, price just takes the liquidity, grabs everyone's stop losses, and then continues to go to the downside. So basically, there is a theory, you know, that the banks are manipulating us. You know, they're using us, using our money, using our stop losses, so they can, you know, trade with no problem. Because again, they're opening position with millions and billions of dollars, and they need to generate liquidity before they enter a position. So liquidity acts like a little bit like the same way as imbalance, you know. So it tends to get filled. So you can use it again in your advantage. You know, for example, you're gonna have you know, maybe something like this. You're gonna have a double bottom pattern, and then price is gonna make this a standing price action. You know, it's gonna make liquidity here, it's gonna make liquidity here, and then this is gonna happen, and you're gonna execute your trade right here. So you can take this liquidity and take this liquidity. So if you take trades here, you're gonna have, you know, a direction. You're gonna have more confidence in your direction, because, you know, price is gonna take that liquidity. But again, guys, at the same time, it doesn't mean that liquidity needs to get filled right away. So do not overcomplicate, or, you know, this, because, you know, there's a lot of traders who are again making the same mistake as imbalance. Liquidity doesn't need to get filled right away. Liquidity can sit there on double top pattern here, and it can do a lot of things before that liquidity gets taken. Okay, so yeah, just to let you know. So basically, there are, you know, a lot of types of liquidity. You're gonna have a double bottom, double top liquidity. So above the double top is gonna be liquidity. You're gonna have a double bottom pattern. Below it's gonna be liquidity. You're gonna have triple bottoms, triple tops. You know, above is gonna be liquidity. When you're gonna have a resistance zone, you know, you're gonna have a sideways trend like this, and there's a resistance zone here, and there's a support zone here. Again, you're gonna have liquidity above, you're gonna have a liquidity below. There is also trend line liquidity, so you're gonna have, you know, this bit of price action like this. There are traders who are trading this trend line, and then price is gonna you know, take their liquidity, so you can use that also to advantage. So there's a lot of types of liquidity, like, you know, basically every retail pattern there is equal highs, that means double top, double bottoms, trend line, you know, sideways trend, support, resistance, etc., etc. So when you start to see the liquidity on the chart, you understand a lot of things. So this concept is going to help you a lot, because when you understand the liquidity, you are going to be able to predict the price movements a little bit more. Okay, so for example, here, you know, there's a lot of liquidity. Look, there's resistance, you know, or triple top, whatever. People are selling here, people are selling here, people are selling here. Price is moving a little bit to the downside. Again, makes liquidity here, because there are people selling as well here. This is liquidity, this is liquidity. What price action is doing? Boom, swipes them out, takes all the stop losses, and then continues to the downside, to trade to the downside. You know, so for example, there is also liquidity here. You know, there's a lot of liquidity here. What price action is doing? Swipes them, takes their all their stop losses, continues to downside. You know, so for example, so let's say here there is a liquidity also here. Price is grabbing that liquidity. You know, so there is liquidity here, there is liquidity here. Prices, look at this. You know, you have liquidity here, just takes their stop losses, moves in another direction. Takes their stop losses, moves in another direction. You know, so you can find a lot of liquidity on the charts. Trend line liquidity, double top, sideways liquidity. There's a lot of liquidity, you know, all over the charts, and you can use that in your advantage. For example, you see that this move has left imbalance behind, you know, and there is a little bit of trend line liquidity, you know, here as well. So there is double bottom liquidity as well here, you know, and maybe, you know, you're gonna have something like this, weakness to the upside, you're gonna have a breakout to the downside, and you want to retest this area, you know, and you want to take your shorts to take this liquidity, you know, take this trend line liquidity and get this imbalance filled. So you can, you know, you can use the concepts in your advantage, because, you know, price is most likely going to continue to take that liquidity, to take all those stop losses, you know. So I'm gonna show you a few examples as well. How can you use, you know, liquidity in your advantage? So guys, this is really high probability when you see something like this. So as you guys can see, we had weakness to the upside. So, you know, price was ascending to the upside. Price is doing this, basically showing us weakness to the upside. Then we had impulse, correction, impulse. Look at this beautiful momentum, you know, impulse, correction, impulse, really beautiful. Then we had this supply zone here, and price started to retrace, then made a liquidity, you know, and then this is used as inducement. It's called inducement. Okay, so price takes their that liquidity, reacts to our block, and we take our trades here. So when you have that confluence, you know, basically every entry that you get, you know, that is like something like this, you know, standing price action, move to the downside, there is a supply zone here. If price action is moving in this ascending price action, it's generating liquidity here. So your trade is going to be higher probability. Plus you're going to have extra confluence because this is a standing price action. And, you know, it is indicating that we do not have momentum to the upside. There is a weakness involved. And plus, you know, we have again that direction. So we want to take that liquidity. Again, the same thing, you know, when you have a double top liquidity. So let's say you have something like this, you know, you have a standing price action, price breaks below, you know, makes a change of character. You want to trade from here, and price does this, you know, makes this liquidity and then takes you in position and continues. So this is called a double top. You know, this is retail pattern, double top. There are sellers who are selling here, price wipes them out, takes their liquidity, and then boom, the real movement starts, you know. So this is your extra confluence when you're, you know, looking at everything. So price can also make the liquidity right here, so as you guys can see, and this trend line liquidity. So your trade is going to be automatically more high probability because you have, you know, if you take your trades here, you know, all those stop losses were taken from those double top sellers, and then price is reacting, and then boom, you have direction. Also as well, you have liquidity, you know, in your direction, so you can use that, you know, in your advantage. So next example that I have prepared is again pretty much the same thing, guys. So you're using basically liquidity as extra confluence. So your trades are gonna be, you know, a little bit more high probability. You're gonna have confluence. So prices here moving to the upside, showing us weakness, breaking highs, retracing, breaking highs, retracing. We have this move to the downside. We reacted to this order block, retrace. We broke this order block, a little bit more aggressive retest coming on volatility. And, you know, if you took the trade, you know, you can look at to target this liquidity right here, because you see that we have this double bottom liquidity here. So we had also liquidity here, you know, look at this triple top liquidity here. So what price action is usually doing when you have like something like this, when you have sideways trend like this, you're gonna have sideways trend like this. As you guys can see, you have liquidity here, you have liquidity here. Price action will take all of those stop losses, you know, the people who are selling here, selling here, selling here, they're gonna take their stop losses, and price action is then gonna continue to downside to take all of these stop losses. So price action usually does this, but you never know what is first going to, you know, for example, it doesn't mean that price action is going to continue first to go to the upside and then to the downside. Okay, so price action can easily do this, takes their stop losses and then their stop losses. It can happen as well. So, but yeah, using liquidity, you know, as an extra confluence when you enter a trade, you can do that. So you can target this liquidity. You know that the most likely price is going to take them because it took all of this liquidity, and right now, you know, shows this weakness. Even the trade is a little bit more aggressive, you know, you're gonna have a little bit more confidence on your side because you're targeting this liquidity. You know, the price is most likely going to, you know, take it. So this is why your trades are gonna be a little bit more high probability. So, but also guys, at the same time, the same example as imbalance. Okay, so liquidity doesn't need to get filled right away. Okay, so this is why traders are gonna see something like this. I'm gonna draw the similar pattern. You had a standing price action here, a standing price action here, then we had a breakout to the downside, made a change of character, then we had a retrace, a little bit of retrace. First entry was here, as you guys can see, a little bit more aggressive, but this was a scaling position, but never mind. So you're gonna have a retrace and you're gonna have impulse to downside. So I'm calculating, so we do not have this retrace, but this was extra confluence to reaction. So let's say that this was only one impulse. So impulse, correction, impulse. You have impulse, correction, impulse, and then you're gonna have liquidity maybe here, or you're gonna have maybe liquidity here, and let's say you have another order block here and you have imbalance here. So what are people going to do and how they think when they see this is that they are 100% always going to execute out of this second order block, or so-called extreme order block. And again, guys, that's not the fact every single time. Sometimes double confirmation entry is going to be higher probability. Okay, so here we wouldn't have a double confirmation entry because this was a retrace, but never mind. Let's say that this was a one candle. So sometimes, you know, it is better to execute from first order block, and sometimes it's better to execute out of double confirmation entry. Okay, when is that the case? So first, in this bit of price action, again guys, we are seeing beautiful price action. Price is moving in this standing price action, showing us weakness to the downside. As you guys can see, also we have structure. So structure is bearish. We're putting new lower lows in the market. Price is clearly indicating to us that it wants to trend to the downside. Okay, so it has momentum. Momentum is here. So we have this standing price action. We have this beautiful impulse to downside. We broke this change of character. We made break of structure. We made a retrace. Again, another breakout. Look at how beautiful this momentum is. We had this impulsive break of structure. That's the first thing. Second thing, we had a momentum without retraces. Third thing, we had imbalance left behind. Beautiful, beautiful entry. Okay, and then we had impulse, retrace, impulse coming back a little bit more aggressive, and then boom, continuation to the downside. So in this example here, guys, when momentum is present and when price is clearly indicating to you that price wants to trend, you want to take advantage of that. And people always tend to see this liquidity right here, see this imbalance right here, see this extreme here, and they always, they want to be more safer and execute out of this extreme. But again, guys, if there is momentum involved in the market, you want to take advantage of it. Okay, do not get scared if you have a little bit of liquidity or imbalance below or above, because again, price doesn't need to fill that liquidity right away. Okay, sometimes it can happen that days are passed before we take that. Okay, so again, if you have your high probability sorry guys if you have your high probability entry right here, you should take it. But again, if price action is making liquidity here, price action is making liquidity here, this would be really high probability entry. And let's say, for example, we didn't have the nice candle close. So let's say we have that big wick here. We have that big wick, of course, and you had a even aggressive retest coming back in volatility. This will indicate to you that this trade, this order block is aggressive. And then you're gonna trade based on this, based on this second order block, double confirmation entry, safer entry. Okay, so there is a difference. There is difference when you're going to execute out of the first order block when you're going to execute your trade based on second order block. Okay, so this order block is used as a momentum zone when price is clearly indicating to you that it wants to trend. Momentum is present. You want to take advantage of it. And when price action is showing you weakness and aggressive pullback, forming volatility, everything is aggressive, this is not a safe zone anymore to trade, then you're skipping this and then you're waiting for this one. Okay, but there is difference and people do not get it. People do not look at price action enough in the details, and they skip these beautiful trades because they always look at extreme. They want to trade extreme and that's it. Okay, and they are not taking advantage of this beautiful momentum. Standing price action indicating weakness. Structure is on our side, making new lower lows. Impulse correction, impulse, beautiful continuation pattern, retest, and then boom, continuation to the downside. Beautiful example. So guys, again, liquidity is going to help you a lot. In your trading, you're gonna know where is safer to trade, where is not that safe to trade. You do not want to be liquidity, of course, so you can use it as a direction. You're gonna see when you start playing with naked charting. This is the exercise that we do in community. Later on in the video I'm gonna show you guys how to do it. When you're doing your naked charting, when you see liquidity, when you train your eye to see liquidity all over the place, you're gonna guess direction, where is most likely price going to continue, and you're gonna see, it's a really fun and interesting exercises, and with the help of price action and liquidity combined, you are really going to know where price most likely is going to continue. It's going to go based on momentum, liquidity, imbalance, and all those concepts. But again, do not overcomplicate it. Okay, remember that imbalance and liquidity is there, but again, it doesn't necessarily mean that it needs to get filled right away. So again, if you have momentum on your side, you want to take advantage of momentum, even though if you have liquidity or not here. So do not get, don't think a lot. Oh, I have a liquidity above my order block, I don't want to get involved. If price action is telling you that it's higher probability to trade it. You do not care about liquidity above. Okay, so if price action is showing you that there is a weakness involved, and price is most likely going to feel that imbalance or liquidity, then yes, trade based on safe order block, guys. So yeah, that's pretty much it for this video. Hope you liked it, hope you enjoyed it, hope you learned what is liquidity. Again, guys, if you have any questions, okay, or if you need anything, just DM me or shoot us a message in the community, and we are going to be more than happy to reply and answer all of your questions. So yeah, that's it for this video. See you in the next one.